Hey everybody, we're going to try something different today. Not only are we going to look at Opendoor stock, we're also going to compare Opendoor to another stock. And you know what I'm talking about. I'm not talking about AMC, I'm talking about Gamestop, GME. We're going to compare Opendoor to Gamestop. And I saw some things that look very, very similar to Gamestop. I'm not saying Opendoor is going to be like Gamestop and go to $100 plus. But I saw some similarities and I want to show you right now in the chart. So let's take a look at it right now. All right, here is the infamous GameStop chart when it went crazy. Absolutely crazy. Short squeezed all the way up to what? On here, it says $120. I want to show you this because it looks very similar. I saw some similarities. The first similarity I want to talk about is how GameStop actually went under $1 as well. If you look at the chart, GameStop actually went to 64 cents at one point right here. I don't know if you can see it. Let me zoom in. GameStop, 64 cents right here was a low. Did Opendoor do the same thing? Let's check it out. Opendoor didn't hit the same mark, but it was close. Opendoor stock low was 50 cents, 64 cents. Not too far off. It hit 64 cents back in April 2020, and it ran to about $5 on November 30. So you're talking about April all the way to November. So it took about 7 months from the 64 cents to hit the $5 mark. So right there, that shows you if there's a short squeeze in Opendoor, it's probably going to take some time. It's going to take some time. It's not going to be a one-day thing. People forget stock market is all about patience. How much patience do you have? If you're willing to wait for a possible short squeeze, don't mean it's going to happen. A possible short squeeze, you will reap the benefits. That's how the stock market is. Whoever has the most patience usually win at the end. People who don't have patience, they sell. But of course, we don't know if this is actually going to short squeeze. But if you have patience and it does, you will be rewarded. And next, what I want to do, I want to show you the pattern of how GameStop traded. So pretty much we get a lot of volume, then it goes up for a while. And then we get all red candles, everybody taking profit and selling. And then we get a phase where we're just consolidating a straight line, horizontal line, just going straight. Then we go up a little bit. That broke the last high right here, 397. This time we break 488. This is GameStop, not Opendoor. Remember that. Then after that, we go down. Profit taking, very, very natural. And then after the profit taking, we had a little consolidation, horizontal line again, and then we back up again. This time we break 559. We broke that $4.85 mark, and now we at 559. Higher highs, lower lows. And then once we hit that $5 mark, very similar to Opendoor, we came down from $5 all the way back down to $4 again. I'm not saying Opendoor and GameStop is going to follow the same pattern if it short squeezes. Charts usually never have the same pattern. There's always some similarities, but never the same thing. GameStop average volume day to day before it pumped up, it was 23 million, 27 million, 40 million, 20 million, 24 million. So it pretty much stayed in the 20 million area for GameStop before it pumped. And then the first pump was 578 million volume. That's a lot. And then the next day, 374 million. And then what really created the short squeeze is when we had 700 million volume days, 783 million, 707 million. 703 million. That's just a lot of volume. There's no way you can keep a stock down getting that kind of volume on a daily basis. With that much buying volume, there's no way. That's why it short squeeze the way it did. Now let's look at Opendoor. The average volume pretty much for Opendoor before it had a little tiny mini squeeze was 96 here, 100 here, 61 here, 51 there. About 70 to 100 million volume before the little mini squeeze. And then when it did squeeze, we had about 303 million, 550 million, 589 million, and then 1.8 billion volume. The next day, 1 billion volume. Now, the thing about this is the reason why I didn't go straight up like GameStop. It just, we had a lot of selling in that billion volume days. And that's why I couldn't continue to go up. People are selling a lot of a mix of buying and selling. So we had a billion volume. The share structure is a little bit different. But if you have that much volume and that much buying volume, it's going to go up. It's going to go up. $50, $70, $80. And right here, now we're in a sideways pattern for Opendoor, which is good. Every time you have a pump, you're going to have some sideways trading, which is natural and good. People saying Opendoor is over just because it's not going up. They're going to be wrong if it's trading sideways. But when the stock is trading sideways, it's usually preparing for something big. It could be the downside or it could be the upside. We just need more attention, more people investing, more people buying, and yeah, we can get a short squeeze, no problem at all. Last but not least, what I want to talk about is the companies. A comparison of GameStop and Opendoor. GameStop was a failing company. Physical games It's out of style. It's not going to come back. You may have some collectors appreciating the physical case, the physical, the manual, but it's not coming back. It's much cheaper to have a game downloaded than actually create a physical form of the game. So yeah, it's not coming back. When you go to GameStop, maybe you want to buy a console. That's not bad. I'd rather buy a console from a store than have it delivered. And then Opendoor, it's a failing company temporarily. I'm not gonna lie and tell you Opendoor is top-notch company. It's going to go straight up like an Apple or an Amazon or a Walmart. I'm not gonna say that at all. But it was doing pretty well before the housing market went down, before the interest rate went up. Nobody can deny that. So if you want to compare the companies, I would say Opendoor is actually the better company than GameStop. AMC a little different. It went down because of COVID, and people really never came back to the theater like they were before. And then you have all these streaming devices. People like to stream movies instead of going to movie theaters. But you never get the experience of a movie theater from streaming from your home. And I read some reports that movie theaters are coming back in style. So I kind of like AMC better than GameStop if you're talking about a long hold, unless GameStop changed their business model. So yeah, Opendoor, if it can survive the time needed for the interest rate, to come down a little bit, Opendoor could survive and keep going up. Or the other option, we get a short squeeze. And how do we know when there's going to be a short squeeze? We look at the volume. Just like GameStop, when you get in more volume than the average volume, and it keeps increasing more and more daily, and the short squeeze could be near. But for the squeeze to be successful, you need more buying volume than selling. So when some traders see this little sideways trading, they may say, oh, this stock is over. But when I see this, I'm like, it has potential. It does have potential still. This is why I always say, if it's going sideways, I'm fine with it. If it starts to go down to 125 and lower, under $1, that's when the alarm bells start to ring. You got to watch out for it. So yeah, Opendoor and GameStop does have some similarities, and an Opendoor chart could squeeze. We never know. But when we see a lot of volume coming in after a long sideways trend, watch out. It could be near. All right, thanks for watching. Don't forget to subscribe, and more videos to come.